Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So let's talk about this very interesting article that comes out from Zero Hedge. I'll put the link in the description so you could read up on it. Basically it says 8 signs that we are right on the verge of a major credit card debt crisis. So what are those 8 signs? So let's go through these 8 signs. It's really important because, it could tell you that, hey, how are things going on in the economy, in the markets? How are people feeling when it comes to their credit and their debt that they've got? And it also is a sign that, hey, you should be very careful with taking on more debt, leverage, credit in the current environment that we're in and for, the upcoming possible recession. So let's get into it. Number 1, the total amount of credit card debt in the US has surpassed $1 trillion mark and is now the highest level ever recorded. So we made a new all-time highs in credit debt. Pretty bad. Number 2, the average rate of interest on credit card balances has now risen to a new all-time high, which is 20.63%. So great, you now have to pay higher interest. Well, because with all the higher rates that we're seeing, the higher interest rates, that has contributed to it. And 20.63%? I mean, tell me who gets a 20% return? It's these credit card companies, these banks who are really milking, the debt and the interest payments. So we've seen interest payments, the level of interest payments are going up. The amount of credit debt that's there going up. So not only more people are taking more debt, but the payments are much higher, right? Especially in an environment where prices and inflation is going up and people are feeling the pinch. Now, number 3, a whopping 47% of all US cardholders are carrying balances from month to month. So they're not being paid off. Another sign here, 47% we're talking about here. That's not far from 50% here. So almost half of Americans out there are holding credit debt cards. They're holding it month to month and they're not paying it off. Now, if we get into it a little bit here, it was 39% in December of 2021. So now that has gone up to 47%. And if you break down, look at all the, and this is for all the age and income groups. But if you break it down to, let's say, certain, generations, let's say Gen Xers, they carry about card balances month to month about 53%. Gen Z, about 52%. Millennials, 49%. And baby boomers, 41%, carrying this month to month balance. So everybody's holding debt and continue to hold debt, and it hasn't got better. So number 4, the average credit card debt level in the US continues to grow. The national average is now sitting around 7,227 according to the survey. So that's gone up. Number 5, most Americans are not running up credit card because they're making frivolous purchases according to one industry insider. Most Americans are doing it because they are under financial strain. Okay, interesting. Number 6, the number of credit card delinquencies in the US has surged dramatically over the past 2 years. So more people defaulting, saying they can't keep up with the credit, can't keep up with the loans. Another negative sign. Number 7, one recent survey discovered that many Americans that are actually use personal loans to consolidate credit card debt end up quickly running up new credit card balances close to the previous levels. So they're using old loans, personal loans, consolidating to wipe up or clean up the other debt and the other credit cards, and it's a never-ending cycle because they end up getting more credit and more loans out there. Number 8, last but not least, at a time when economic conditions are slowing down all over the nation, Americans are becoming increasingly dependent on the credit cards. You can expect this with not only individuals, but businesses as well. So here's the thing, okay? Why do I tell you all of these 8 things there? there are signs people are taking more credit, they're dependent on credit, people live off credit. The whole system itself, if you take any of my courses, you will learn the whole country, the whole system is dependent on credit. The reason why you see growth, asset prices increasing, because of credit, because of debt. Now, with consumers, the fact that we are in a very tight scenario in terms of monetary policy, and the Fed's out there and the central banks are out there to attack inflation, and they will do anything at any cost to bring inflation down to the 2% target. And that means by hammering the labor market, it is going to pose a very bad situation for the banks, the banking sector, for consumers, because as they take on more credit and loans and things get worse off in the economy, people lose jobs, and they're dependent on credit right now while having a job. Guess what? They will be using that credit even further. And if banks decide, and they already are looking to basically trim down the amount of credit they're giving, and also going to previous customers that already have these line of credits, or even businesses that have these line of credits, and saying, hey, you don't really use this 20 grand, we're going to take 10 grand away from you. That is 10 grand of emergency money for someone, for an individual, or let's say a business owner who could use that if times are to get rough. So everybody would scale down. That would be definitely, would affect the business owners there. It would bring in layoffs, and individuals will be affected. Thus, you could see where this leads to, right? The recession that I keep talking about. So be very careful, because unfortunately, as many of these Americans continue to live off credit and continue to pile into credit, things in about a year or so are not looking good. And especially if the job market's really tightens up and gets weak, then you can expect bad things to happen. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.